Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work for years. It's Frank Holmes. He's the CEO and Chief Investment Officer at U.S. Global Investors. Thank you for joining us on a podcast, Frank.
It's great to be here.
Now, Frank, I want to ask you about China since I followed your work and you've said how you travel to China every couple months. What's your opinion about how much China's economy is slowing down right now?
Well, I think there's two parts to China. There's no doubt that the infrastructure and the big build-out that use so much, I guess you could say, generated the bulk of the world's commodity demand, 50%. That has slowed down. But what is growing is technology, is growing internet, shopping. So the government is very much pushing everything they can for consumer spending. And that's where it's tilting from a huge infrastructure story. Now, the infrastructure is still there. The government is promoting light rail train everywhere in the world, and it's accelerating there. But the big use of iron, these big mega projects, that has basically slowed down dramatically.
Yeah, I agree. I've been seeing that too. I've been predicting that for over a year. I thought the copper price would finally fall below $3. You know, it took a lot longer than I thought it would, but it looks like it's finally. I just saw a lot of that demand, you know, based on central planning. It was artificial, but we still see, I think, in the data a humongous amount of Chinese car sales. Right, we're seeing a lot of still a nice increase in Chinese car sales. So the Chinese consumer, they've saved up. I don't. You can speak about this more since you've actually been there more. Are they getting these, you know, subprime auto loans, or have they saved up for many years with cash to buy these cars and they're excited to be driving?
The bulk is cash. The bulk of cars, the whole evolution of car loans that we are privileged in America just doesn't exist over there. And if you do, the bulk of it's going to be cash down. Same thing with housing. It's basically 25% down in your second house. If you have the ability to buy, has to be more than 50% down.
Very good. So you would expect then I think China last year surpassed the United States as the number one world consumer of energy. You'd expect that then to continue then based on car sales and things like that as the Chinese consumer starts driving more and doing, you know, some of these more westernized lifestyle things that many people in the West take for granted.
I totally agree with that. I believe that it will continue. And just like we're seeing when it comes to the world of gold, that they continue to be the net big buyer. Everyone's so bearish, but China continues to have huge record consumption of gold.
Now, for ways to play the Chinese economy, you said it's shifting. I've listened to Michael Pettis talk about how he thinks it's going to shift from, you know, from investment related economy with fixed assets to consumption based. Would you still agree then that Jim Rogers, he says the best way to play China is still through food and energy as the Chinese consumer, you know, starts eating more protein and calories and starts consuming more oil for cars and things like that? Or do you think there's other better ways to play investing in China at this point?
Well, I think that food is no doubt an important component, and that's one reason, if you recall, that the Chinese have come over here and made acquisitions. They're now substantial in the food business because they realize food's a growth sector for them. They like the processes and systems, the cleanliness and everything that America has, and they're going to try to bring that back, but it's really a stepping stone to be able to have the best practices back in China. So I think that there's no doubt food is a key component. The other one is the industrial buildup, that they are building their industrial empire. So in our China fund, I think 15% of the portfolio relates to the industrial sector, which has to do a lot with tanks besides cars, what they're manufacturing over there.
Oh, tanks? So they're building up the military then?
Correct. They are building. So the industrial change that's taking place is because they're becoming a world power. And I think that's the reason why you're seeing such a big consumption of gold, is to back their currency. They're doing many steps. A big part is that one of the hottest emerging markets this year has been China. And they're closing the gap between the A-share listed and what's listed in Hong Kong, so people can easily become liquid. So you've had a big pop in how cheap the A-shares were in China. And two, they've made their currency this year convertible into Singaporean dollars. So the renminbi and Singapore dollars is instant convertibility. And at the same time, they're consuming and consuming gold at a record rate, taking physical delivery of smaller bars. They're shipped from North America over to Switzerland, melted down to smaller bars, and they're showing up in China.
Yeah, I agree. That's what I'm hearing, too, about the physical gold market, how demand out of China and India and Russia is still very strong. Before we talk more about the gold market and ways to maybe invest in gold, I want to ask you, since you do have a China fund, what's your opinion of the accounting practices of these Chinese stocks? Are they using more aggressive accounting than that? Or what should investors look out for? Should they only trust a mutual fund manager such as yourself that's going to do the extra due diligence on some of these Chinese companies? Because we've just seen, an enormous amount of accounting frauds for Chinese companies where they fooled, billion-dollar hedge fund managers who've had a team of chartered financial analysts look at the books.
Well, I think that this fraud is a horrible thing that exists everywhere in the world. And no doubt that investors should have active investors such as ourselves and other people that are doing this, another deep dive and another layer of due diligence of looking at their financials and trying to understand them better. So I think the cleanest way, if you want to do, is buy ADRs, China in ADRs, and you can get a qualified North American traded security that basically is the mirror to what's listed in China. And there are many of them.
Okay, very good. Now, I want to transition now to oil. You live in
But
Texas.
before we do that, before we transition out of oil, I published a piece recently showing that the real key indicator for investors, if they're trying to understand commodities, is in the future, is to look at the PMI, the Global Purchasing Manufacturers Index, is a reflection of what's expected for 6 months out, what people are ordering now to manufacture. So to manufacture something, you have to order copper, you have to order zinc, steel, make steels, nickel, all these other parts, and you need copper. And then you need energy to heat the furnaces to manufacture. So what we've noticed is that when the 1 month is above the 3 months, then we can see with a probability from 65% to 83% that oil rises, copper rises, energy stocks and material stocks rise in the U.S. But when the 1 month is below the 3 months, it's 100% of the time the oil prices fall. It's 79% of the time copper falls, energy stocks fall, and basic material stocks fall. Well, we just experienced that. The global PMIs turned negative earlier this year, and we're witnessing months later a big drop-off. So I think for investors, when they're trying to get an idea of this 800-pound gorilla, China, when its economy starts to pick up, it's really important to see the synchronized growth that comes from J.P. Morgan's global PMI.
Yeah, that's a good point there. But I think the oil market, especially with the car sales, like I said, I think that's more insulated than necessarily the copper market because, it's a consumer discretionary item, like you mentioned earlier. People have saved up. They want to be driving. They're not going to necessarily, if the price of gasoline goes up a little bit more, they're not going to. It's not going to force them to cut back on driving as much as, say, an American consumer would because, the Chinese person has saved up more to want to drive. And it's something that probably the whole family may have one car or in China or India, and they've chipped in and they want to, they really want to drive it around.
Right.
Now, I want to transition to oil. It was a great point about the manufacturing index. You just put out a really interesting piece about oil prices ready to break out of the trough. Since you are in Texas, for our listeners who are not familiar with your company, what's your opinion of what's going on in the shale oil industry with production costs? Do you think we're going to see some bankruptcies here if the oil prices go much lower in the near future?
Always. There's always going to be, and the companies which are most leveraged, the bank will call their loans. It's just a matter of fact. And if you take a look at a lot of the shale companies, I think out of 53 of them, 50% of them have bank debt, and they finance this huge growth. So one has to be able to make sure that their covenants are very strong, that they don't have trigger points where if their stock falls below, some of these guys get loans, and the loans automatically trigger debt repayment if the price of the commodity falls below a certain number or the stock price falls below a certain number. And I don't have the debt covenants for every one of these companies, but if something is a factor, that's a risk.
Now, also for value investing for the oil, obviously there's bankruptcy risk for some of these companies. Do you think the oil service industry, do you think the drillers, the ones who don't have as much debt, the oil service companies, the drillers, they're obviously going to get hurt if the frackers, they don't have the exploration budgets or the budgets to keep drilling, but these guys are going to survive. Do you think we're close to a bottom here in oil, or do you think OPEC's going to continue maybe playing games to talk the price down further to put more shale producers out of business?
I don't think it's so much as to put the shale people out of business. I think it's more geopolitical. Who's going to go to business is Putin and Iran and the axis of evil, Venezuela. It's just devastating to these countries, this drop off in the price of oil. The countries such as Kuwait and Saudi Arabia, they're very worried about Iran, and at the same time Syria. So you're going to see Russia, Syria, Iran, Venezuela, Nigeria are all going to have a difficult time because none of these countries have a sovereign fund like the Norwegians have.
Yeah, that's a great point. And the Saudis and Norwegians have saved most of their oil profits from decades ago, whereas these countries like Nigeria and Venezuela, when they make money, they spend it. They don't save any of it for a rainy day for when the oil prices drop, and then they go begging to the Saudis, right? Begging the Saudis to cut oil, so to cut the production numbers so the price starts going back up.
Mm-hmm. So correct.
Now, in terms of value in the oil industry, obviously there's pitfalls, and some of the higher producing shale plays can go bankrupt even if they're hedged because of their debt covenants. But do you think the larger oil producers, the integrated or the oil services, are safe at this point in terms of their dividends or distributions, or for people, value investors, to start looking here?
I think that you're going to have to wait till this quarter's numbers come out. I think it's going to be really key. And historically, oil bottoms in February, if you look at a seasonal chart. So this could all be just a perfect storm. Oil makes it low, a seasonal low, and all the results are coming out from this quarter and how bad they are. Will probably create a even worse scenario of storytelling that will probably give you a catharsis.
And the Chinese are very astute. In 2009, when the oil price crashed a lot from 2007, I believe, the oil price started at 140 something a barrel, and then it dropped to around, I think, 35 around 2009. But the Chinese were in there buying long-term oil contracts from Russia and Brazil way over the spot price. CNBC and Bloomberg made fun of them. Do you think the Chinese are going to be doing similar long-term oil investments in the next couple years in terms of stockpiling oil in the tanker and then maybe going and buying undervalued oil companies in the U.S. or Canada?
Yeah, I think that'll take place, and you'll probably get news of that coming out in the new year.
Very good. Yeah, I think the Chinese are really astute. And, if there's a drop in the commodity prices for 1 or 2 years, they just see that as a little blip on the radar screen. They don't really care that much when they're doing their planning to feed people and stuff like that. They don't care about 1 or 2 years.
Uh-huh.
Now, I want to transition here to our last subject here, something about gold. You already outlined your opinion of the demand for the gold market. There, despite the paper price of gold dropping, we've just seen an explosion in the physical demand market the last couple of years. Do you think this is going to continue despite China slowing down?
Yeah, I do.
Now, do you think then that the Chinese, you mentioned about the gold market before, something very interesting that I haven't heard any other analyst talk about the gold market, the fear trade and the love trade. Do you think the Chinese are buying for both reasons right now, or only because of one?
I think that the love trade has had a dent to it because the love trade is highly correlated to GDP per capita rising in China, India, Middle East, etc. The Middle East has enjoyed strong gold consumption for the love trade, but China and India, on a real basis, their GDP per capita has not been growing, and so that does impact it. So I think that one has to be cognizant of it. Now, if we get this turn in the economy, because the falling oil prices is a massive tax cut to Chinese, to Indians, to Indonesia, to Vietnam, to Thailand, to Europe. So it ignites a lot of spending. It's really tough on countries like Venezuela, Colombia, the net exporters that need that additional oil revenue. So I think you'll probably see in 6 months from now a turn up in spending.
Yeah, I think there's a bottom here. I think the physical demand is putting in the bottom, and I also think there's supply problems in the gold market coming soon with the gold miners. A lot of the primary gold miners, they just can't seem to cut their costs enough at this point. I mean, they've cut their costs a lot in the last 18 months, at least most of them have, but they're at the point where I don't think the miners can cut that many more costs without starting to, shut down a good amount of their mines.
Mm-hmm. So I guess I'm trying to highlight to your listeners is that there's a high correlation between gold and oil, and they don't always move in tandem, but they move in the same similar trend. And we've seen here the gold market tank first, and then the oil market all of a sudden cratering along is catching up to where the decline has taken place. When you have such a decline, one has to say, okay, who's going to benefit? And will it have an economic benefit that's sustainable, that's important? Well, it will, and this to me is the next leg, that it increases the GDP per capita spending. It gives more money to the Chinese, that disposable income, just like in America I've been writing about, by a lot of the consumer companies in America. Walmart, all these stores are going to have record banner quarters right now because of the tax break of the gas pump.
That's interesting. I don't know if I necessarily agree with that. I mean, obviously, like the airplanes have gotten a stimulus benefit because of lower oil price, but there's still a lot of people who are underemployed or unemployed people in the U.S. who don't have the discretionary income even with a cheaper oil price. But it's neither here nor there. And I wanted to ask you about the ways you think are the best for investing in gold. Should people be buying physical metal? Do you view that as an investment then, or are mining stocks only investments and metals just a form of insurance?
Well, for the love trade component, the best thing to go and buy, if you're not going to fly over to Turkey or India to buy beautiful gold jewelry with very little markup, because the markup is very, very modest when you compare it to other countries. So when you go to the Middle East, and you go to, India, you're going to pay a 10% markup for beautiful gold jewelry. When you go to Fifth Avenue, you're paying a 400% markup. So how can you get this great deal in America with jewelry? You buy gold estate jewelry. You can basically get the weight of the gold, know what it is, trading it per gram, 18 carats, what's that worth? If that's the quality, you can have it weighed, and you can basically buy beautiful jewelry at a huge discount than brand new gold jewelry with a 400% markup on Fifth Avenue or big malls. That's one way to do it, so therefore you can wear your gold. I think that's an important psychological importance. I think it's very important for people that are out there buying, because that's what takes place in Chindia. Two is you buy gold stocks, and I've recommended that people, if they're not going to buy a gold active manager like ourselves, then what they should be looking at are royalty companies. Royalty companies have dividends, which are higher, like Franco-Nevada, than a 5-year government bond. They have higher profit margins. They have lots of cash in the balance sheet, so you can buy Franco-Nevada, Royal Gold, Silver Wheaton, and you've got exposure at a very high profit margin without all the headaches you have of a gold mining company. So you have a call on the gold production of Gold Corp. You have a royalty on Barrick and Newmont, most of their gold production.
Yeah, I completely agree for people that are looking to get exposure to gold and silver besides just buying physical metal as insurance and wealth preservation. And that's a really good point you brought up about the jewelry. I mean, it's not something most people would think about, that they can get jewelry at a discount that way, at least off a spot price, because, when you buy gold jewelry here in the U.S., it's just marked up so much. People are like, oh, my God, it's, so expensive. And diamonds are just so much more marked up than I think their real wholesale costs. Excuse me. Sorry, my voice is going. That's
a very good point, because we wrote a piece on that, explaining to investors that 25 years ago, as you bought a 1-carat diamond, a beautiful diamond, it was valued at $6,000. Today, it's worth $12,500, that 1 carat, high quality. But Tiffany stock has gone from $6,000 to $350,000. So I would buy Tiffany stock.
Yeah, and the miners, the miners, like the primary gold and silver miners, when the gold price went up, I mean, their costs went up. So they weren't generating enormous amounts of free cash flow. If you went back and look at their financial statements from 2010, 2011, most of them did not have the free cash flows that the market was expecting because they started producing marginal ounces of gold. Foreign governments in Peru or Bolivia or Ecuador or wherever started drastically levying on extra taxes. And it's the industry, I think, Frank, I know you cover a lot of these companies too. And I look at these companies as well. I just think the management teams for many of these primary gold and silver miners, they're awful. They don't know how to generate free cash flow in bear markets and bull markets. They're not consistent. They like overpaying for acquisitions at the top. At the bottom, they're writing it off like what Barrick did with layoffs. And it's just very frustrating as an investor to look at, across the board, so many bad decisions by management teams.
Well, one of our favorite diamond companies is called Lucara. LUC is the symbol. It has $1 billion promoter behind it named Lucas Lundin. It is selling high-quality diamonds. I think that this is just one of those great little stocks to take a look at that's thrown out $50 million. I know we lent them a couple of years, only 2 years ago, $50 million. They paid it all back.
Wow.
They paid it all back. The margins are massive. It's basically shoveling gravel and sifting quartz rock, which are diamonds, from gravel. That's in very simple terms. All they do that. There's no chemicals. There's nothing. It's so clean. It's a simple rock sorting business. And those high-quality diamonds that they have from Botswana are just amazing, the cash flow they get from them.
Yeah, I've invested with the Lundin family before. I bought Lundin Mining in 2009 after it crashed to like 20 or 30 cents, and I did pretty well off of that. I think they're a really quality resource investing family. Now, what's the symbol for Lucara for our listeners?
LUC, it's in Toronto. The revenue is $240 million.
Nice.
I mean, it's tremendous growth. It's up sixfold for us in revenue growth.
Well, the Chinese are buying lots of assets. There might not be as much real inflation in the real economy as people were expecting, with all these quantitative easing programs, but there's definitely been a lot of asset price inflation in the stock market, the bond market, the real estate market, in diamonds, in fine art, and things like that.
I agree.
Now, Frank, please tell our listeners, as we wrap up the interview, more about your funds and which ones you have available for listeners out there who want to diversify into different asset classes.
Well, we have, I think, a good balanced spectrum. We have growth with the Holmes Macro Trend Fund. We have the All America Fund, which looks for dividends and companies buying back their stock. And then we have our famous US VSP, the first no-load gold mutual fund in America. We have World Precious Minerals, which is in the more junior speculative range, but outperforms the GDXJ, which everyone likes to seem to trade around. And we have Global Resources. We have Emerging Europe, which I think is extremely attractive because Europe's still beaten down, and the valuations for companies are half of what they are over here. And we have a China fund, and our 5-star fund is called Near Term. And Near Term is a short-term, high-yield, AAA rated tax-free fund. And the reason why I share this story with you is because in the year 2000, had you put money into it, you've not had a down year in 14 years. You've had conservative, modest growth, but the S&P during this time period fell twice 40%. And it took it 13 years to finally catch up to the dollar value that's in Near Term. We've done this research with gold, and we've had it 50-50 with gold, and in the past 14 years, and it's got much better performance than just buying gold. Gold has a tremendous volatility. So if you're looking to make an investment in the S&P 500, or you're looking to invest in gold funds, etc., we think that NEARX, stock symbol NEARX, is just a great platform, a basic core position for investors, and it pays monthly dividends, so it's a very attractive way to build wealth.
I don't know if you're familiar with Harry Brown's permanent portfolio, but he set it up during the 70s stagflation, and he said, people should be, I think, a quarter gold, quarter stocks, quarter bonds, and I think the last one was a quarter real estate or quarter cash. Yeah. So that would make sense then that it would fit in there for at least some bond exposure to reduce volatility.
Well, in a low interest rate environment, almost operates now as cash because the maturity is very, very short. And money yields only give you 1 basis point.
Yep, financial repression all over the globe.
Yeah, so then therefore, how do you step up? So what we've done for near term is made the price $2 NAV. So that means it has very little penny volatility. Same overall returns as if it was $10, but the fact that it's $2, it has a lot less of this noise that happens in bond markets. Which makes it better for investors who are looking to a place to park their cash. They don't want to see their cash going up and down, tremendous volatility.
Yeah, it's definitely a volatility-reducing strategy, which I think a lot of listeners are looking for, ones who had too much exposure to gold and silver during 2011, and they're still trying to pick out a bottom, and it looks like we may have bottomed here in gold and silver. I don't know your final thoughts here, if you think we finally bottomed here in gold and silver, but I mean, we have to bottom at some point or all the miners are going to go bankrupt, right?
Yeah, well, there's usually get the rally from this point on till the Chinese New Year, which is February, first week of February. So that's something that's just to bear in mind, this big volatility surge we had last week. I think it's important for investors to take a look in the stocks. There's going to be still lots of tax loss selling. And also we did in this research, we published on it, if you go to usfunds.com, a wonderful piece called Managing Your Expectations. Life is about managing expectations. It looks like a guy in a suit on a surfboard of dealing with volatility. And what we notice is that the resources or the GDXJs of the world or the Canadian industry, stock market, it falls in the afternoon. So the best time to be buying these gold stocks is going to be in the afternoon. And if you're selling for tax loss selling, most of it happens, the best prices are actually in the morning, not in the afternoon. So that's the way to be able to sort of be contrarian, and we like to do this type of research as part of our fiduciary to try to, as much as possible, buy low, sell high.
Yeah, I think that's the goal of any long-term investor, although now most people on Wall Street are not long-term anymore. I mean, with these trend traders, these high-frequency trading algorithm guys, their idea of a long-term trade is holding a stock for a minute or a day or a week or something like that, and it's just the markets have just kind of gotten ridiculous with the amount of trend trading and high-frequency trading algorithms and stuff for a value investor like me.
It's good that you're giving people guidance as value investors.
Well, thank you very much for your time, Frank, and hopefully in the future we can have you back on to talk about China and the resource markets and other opportunities. Great,
that's great. And listen, happy holidays to all your listeners, and wishing them buckets of health, wealth, and lots of laughter.
Yes, thank you. You too, Frank. I appreciate it.
Take care. Bye.